let's first look at the FEZ. This is the weekly analysis in FEZ. This is the Euro Stoxx 50, which shows you the 50 different blue chips in this index from 11 different countries. Now, this pattern actually is similar to what we have here in the United States, though the peak in here was made earlier than it was made in the U.S. The U.S. it was made out over here, where over here it was made some months earlier. Excuse me, I still have a COVID cough. So the what you're looking at are cycle brackets on the bottom. These are not cycles. These are simply a drawing tool representative of the energetic movement in the market, essentially money flows. And off of the, you get messages off of the different time frames in here, and we do multiple time frame analysis. So you can see in here this big strong cycle as it rallied strongly and came down to support. And when you have this bullish configuration and translation that we see in here, that says you're going to continue on the upside. And you had a similar one or stronger right in here, as you could see. But then you made this double top, and once it broke under this level, it warned that a major top was in place. Now, each time you get into these areas of nesting is where the corrections come. That's where there is the biggest downside risk. So you see that right over here. This, of course, was the pandemic break. This right over here, this one here, these are these areas, and this one right over here. And now look what we are. Now, I'm going to take a little closer look right there. And you can see here, looking at the FEZ, the big blue chip stocks out of the Eurozone, that each of these minor cycles, when you got a rally into those rally periods, you had these bear flags. They failed in resistance, as you could see there. And then once it broke the bear flag, it got into a big sell-off period. Even in this one over here, bear flag, big sell-off. That's this one here. Bear flag, the nested one here, where two of them to come down together, and the big decline. And you can see that's where we're coming up to right over here. And that is about to break that bear flag. And then get into this period of decline, of correction, where we're in this biggest period of risk right over here, like we were here. This times into late September, into late October, right there is where that bottom is. And it's extremely likely that it's going to break that low. That low is the same place that the United States market made its low. Question is, the U.S. market, which rallied much more, will it make the low in this next down wave? Or will that come later? So you could see in here that the rally did not even make it to the major 38.2, where in the S&P 500, it made it above the major 50. So that's key. It shows you all of the weakness here in the European markets. They have huge trouble, big recession that they have. They have interest rates that have to go up to fight this high inflation, and at the same time they're in an energy crunch. It's like the perfect storm, that cliche, where markets are very likely to get hit in a very big way. There's no saving this. They can't possibly lower interest rates to save this because they have this huge inflation problem. These central banks put themselves into a huge problem. And now they have to let the markets fall so they can deal with the inflation problem. And this, you can see, very likely to get below here. There's a pretty good potential this gets below the $30 number here in this period in October, November. It's important to think about this timing in here because that's when the next low will likely come, the trough, as we say in these nested cycles there. And it's very likely that we're going to see some sharp declines. The question is, can that happen without affecting the U.S. market? Very unlikely. Let's take a look at China, which is in a recession. They are actually trying to stimulate a little bit in there because between their COVID lockdowns and worldwide recession problems, they are in a lot of problem. And you can see in here the beautiful cyclicality also. And each of those yellow zones right in there where you got the corrections, like here and here and here. And here's one coming here. Now, this is out over here, October into November, where this is likely to keep coming down. Now, this has fallen below the 78.6 momentum, and here is negative. And this is where the important support levels are, 2770. this panic low around 26 right over there, and it's going to take those out. Probably get down over here and hit that 24 level, or get down into that fib target zone that you can see right in there, which is below the 22 level. So a ton of risk out over here into October, November, where we're likely to see the Chinese market get absolutely slammed. So that's two of the, that's such a big portion of the world that we're looking at, China and Europe. Europe, of course, we're also considering the UK. And this is a very, very bad picture when we look at that. So now let's switch over to SPY. SPY is a little bit better picture because it had a bigger rally and actually got up through that 50% level. So here is the major 50 right over here, and here's the 61.8. And if we would have closed through there, we got a number there that's a bit of a warning to us that things are maybe changing a little. Well, we're not sure how much they changed. And here in these periods, there are cycles coming down here into September, and then shorter term cycles out into October, which line up with the Eurozone and China. Our original analysis suggested that it would come down and take out this low that it made over here. With it getting up here and getting close to the 61.8, I want to respect that and say that there's a possibility that during this period where the whole world of equities declines, that maybe that only gets down into the supports down over here. That would be under 400 in the S&P 500. And the SPY, and then when all of those make a low, you get another rally out over here. But again, this is just extending the bear market, which very likely goes well out into 2023. So to us, it's just a matter of, is the shape that it plunges in here, then rallies and then falls again out into 23, or does it only get down here to somewhere in these supports, then has another rally out over here into towards the end of the year. All along, we thought the Q4 was going to be positive for the stock market, which would be a rebounding period. We said that in the beginning of the year. And then turn down again. All of this, in our opinion, is just big bear market action. It doesn't matter if it declines here and if it hits support and tries to rally again. It's just very likely to extend out well into 2023. So this is a 1 to 3 month analysis that we're looking at, and our 1 to 3 month analysis for the worldwide markets is that it will have a decline here into September through potentially late October. That would align with all of the world markets, and then after that maybe have a good November and December rebound in there. But the risks are very high right now. We talked about our short-term analysis being such that the rally would likely continue up into mid to late August. We have done that. We're now failing from these resistance areas. We have world markets in very bad shape, and we have the economies such that they are crippled by the high inflation that the central banks created, that the government's spending all that money created, and now they have to correct that. And they're going to get control of it to get their credibility back, and interest rates are going up, and they're going to stay high for a long period of time because they want to make sure they squeeze all that inflation out of the economies if they can do so, and that's going to be a lot of work by them. There is not going to be a rate cutting period at all, maybe not through 2023 at all. So the world is going to deal with higher interest rates that become restrictive and stay there for a long enough period of time. So for the next several months, we'll be looking for markets pulling back, potentially not making a new low in the SPY because the U.S. market is stronger than the other world markets, and then a more favorable November, December, all of that existing within a longer-term bear market.